Hey, before we get started with today's episode, I want to let you know that if you're planning for retirement or aren't sure where to start, we have a helpful checklist for you. We put together a guide called Your Pre-Retirement Checklist and have made it available for free on our website. This detailed checklist covers things pertaining to cash flow, Social Security, Medicare, asset allocation, and living a purposeful retirement. The link to download the checklist is listed in the episode description. Or you can go to wiserinvestor.com, scroll to the bottom, enter your email address, and then you'll have access to your pre-retirement checklist. Thanks for listening.
Welcome to the Wiser Retirement Podcast. We cover financial topics such as financial planning, tax planning, portfolio management, insurance, and estate planning so you too can have a wiser retirement. I'm your host, Casey Smith, guiding you to financial success, or my co-hosts, Brad Lyons and Barnett. Hey, guys.
Hi, Casey. How's it going?
So, recently, I had a client ask me how come we don't do these dinners? And because, he gets these flyers in the mail about dinner. And, I had to explain to him that, a free dinner at Ruth's Chris, well, I'd be happy to take him to dinner. But when you're doing mass workshops at a steakhouse or you get invited to Social Security seminars at the library or different venues, that there's an agenda. And that agenda is typically run by what I call bad actors in our industry that are trying to sell an annuity. And one of their biggest selling points for an annuity has always been, oh, you won't lose money, because it is an insurance product. At the same time, they talk about income in retirement. And so that's what today's topic's about. It's cash flow in retirement. But it's a real conversation. It's not a conversation that is a bait and switch like so much of our industry does in trying to sell products. But the bottom line is, without going into detail about how annuities work, is typically the math never adds up. When you're trying to purchase an annuity, and there's many things that you can do with your money that the annuity companies are doing themselves, except you keep that margin, that cost. And then unfortunately, there's a lot of push now for 401k plans to have an annuity option, and so you can basically turn over your entire 401k to the insurance company. They're going to pay you X amount per year going forward. And, I'll admit there's probably only been a small handful. In 22 years I've been doing this, there's only been a small handful of times where I feel like an annuity made sense for someone. And typically it's people who were just really bad with money. They'd had multiple bankruptcies in their lifetime. They were always in debt, and they would spend right through their nest egg if they had access to it, right?
Well, it does control your behavior, and that's the whole point of how they sell the annuities. There's various ones, like you mentioned, but the main one being an income source. It's annuitization, and it's a guaranteed monthly payment for the rest of your life, and that's what a lot of clients don't really run the numbers to figure out what they could have actually gotten otherwise. But it sounds nice having their own monthly pension, basically.
So I say create your own pension, which we have a whole podcast centered around that. Somewhere in our podcast list, we've got over 100 now. But create your own pension. But that really kind of starts with this journey on how do we set up cash flow for retirement? How is this going to work? And then that's a very common question we have from everyone who's 6 months inside their retirement date going, okay, so how do I get money again? How does this work?
Yeah, it seems obvious to us, but once you've only been saving in 401ks or outside investment accounts, trying to figure out how you actually now get the income is a different story.
So every family is a little bit different, just like how you're saving for retirement might be a little bit different, or how much you're saving for retirement might be different based on your situation. But you kind of have to look at it as you have different tools available to you. So you have Social Security, and when you take Social Security, so that's something you have to solve for. You have potentially a pension available to you. You have hopefully a 401k that you've been saving money in available for withdrawal. You might have a Roth IRA, and you might have a brokerage account. So when you're sitting down and you're looking at all these different investment options, or cash flow options, I should say, Matthews, is there an optimal strategy that we could give our just general audience, because I think it's very client specific at times.
Yeah, I mean, I think it depends on the client, obviously their tax rate and what else is going on, how much their income need actually is from the portfolio versus other income sources. But kind of the rule of thumb and what our software Money Guide Pro is set up as a default on spending order is, your taxable assets being your brokerage funds, and then the tax deferred accounts like your IRAs, and then lastly, Roth assets, that tax-free income that's grown. Obviously, you can change the spending order. We can change the withdrawal strategies, like we said, based on certain circumstances. So that's kind of the encompassing kind of rule of thumb that you hear mostly.
What's interesting is that, as an investor, as an employee, as a worker, you're saving money, for 30 or 40 years, and here comes the big event, right? You're getting ready to retire. And your mindset at that point in time, and this is what we hear from clients quite often, if not directly, accumulation, invest. But now we need to prepare the portfolio to something a little different, right? We're not actually thinking about spending down the assets, but we're preparing the portfolio to pay out income in a predictable stream, to pay the income required above and beyond those secure sources. I think we refer to them as Social Security or pension or some other source of secure income. So now the portfolio has to take over the rest, okay, and make up that difference. And ideally, as an advisory firm, what we're doing is we're preparing that portfolio through time for this singular event, if you will. Okay, it's not an abrupt necessarily change. It's something that we look at over time, and as clients are getting ready for that event, such as retirement, the portfolio is coming along right along with them, almost right beside them, if you will, and it's going to be their partner in their retirement. It's paying out that stream of income that we're going to plan for. But it takes preparation, doesn't it, Casey? It's just not something that can just happen overnight. It's something that we, utilize the investment strategies, investment world of possibilities in order to get to that point in time for that one client, because it's most important to them, and they're the most important thing to us at that moment in time, to have their portfolio ready to go to pay them out that income over time. And it's no secret, but there's a strategy involved, which I think we're going to get into a little bit later. And it works, and it allows you as the investor, the asset owner, to maintain control of those funds, which is very important because there are still things that happen in life where you need a few extra dollars from time to time.
Yeah, the retirement date is a day that maybe hopefully you get to relax and do some things that you've been wanting to do or meaning to do. But for the portfolio, that's really
when it goes to work.
When it's going to go to work. And so there's many strategies that you can do. One of the things we struggle with for young retirees is healthcare. So if you want to be on the Affordable Healthcare Act platform and get the subsidies, then you're going to have you can't have too little income. You can't be below the poverty line for your state, but you also can't be too high either. And so there's this sweet spot. I believe a married couple, it's probably around $68,000, I believe. You can get as low as 30, but most of them try to stay under the $68,000 limit. So that means if you're pulling all your money from an IRA or an old 401k, you could put you over that, right?
It's all taxable income.
Because it's all taxable income. So typically, we're looking at several different strategies. One is, okay, let's keep healthcare costs low until I'm 65. So that may be one cash flow strategy where you pull from. So you might pull from that Roth earlier. You might pull from the brokerage account earlier in order to keep the taxable income down. All you have to worry about maybe is a small amount of capital gains.
Yep, there could be 0% capital gains for some clients at that point, or 15, which is still better than the ordinary income tax rate you would be receiving otherwise.
Correct. And then another strategy that we'll deploy too is, people who are saving now, you should really make sure you have several buckets. One is taxable money coming out. That'd be traditional 401k, IRA, but then the Roth. So you could do a Roth 401k or a Roth IRA, so that you have another option to withdraw tax-free money in retirement. And then once you're there, between age 65 or sooner, if you're not on the Affordable Health Care Act, between 65 and 72, when your required minimum distribution starts, you have the opportunity to start converting some IRA money potentially to Roth. And maybe you get taxed only at 12%. And this works where you have basically no taxable income, right? So then you'd have your income source might be coming from a brokerage account, and then you're going to convert, $50, $60, $80,000 from an IRA to a Roth and pay a lower tax rate than what you would pay when you're 72 potentially, because you can only assume tax rates would have to go up from here based on government spending. I don't see how it gets lower for anybody.
Yeah, and it's a good problem to have, but you've seen a lot of clients that all they had available to them during their working years were those pre-tax assets, so they did a good job of saving, but come 72, they might not even need those funds, but they've got to take a very large distribution from those IRAs and pay the taxes on it. So like I said, it's a good problem to have, and there's some ways that you could get around that with some Roth conversions or other gifting strategies, but just something that you have to prepare for in retirement.
And that's something that needs to be analyzed prior to the end of the year. It's not something you do at tax time. It's something you pick up around September of each year, going, okay, this is what my year's been so far. This is what I think is remaining for the rest of my year. And then this is how much I could convert. So you start kind of coming up with a game plan in September, and you can execute that closer to December. But the idea there is that you want to have that opportunity to pay a lower tax. And I think this is where financial advising comes in to benefit the client as well. As advisors, this is where we step up to show our value, because a CPA's job is to have you pay the least amount of tax, right? So a lot of CPAs will never suggest this because your tax bill would go up, and all they hear all day long is, what's the least I can pay? Where sometimes it's better to pay at a lower rate, because you're not going to get that lower rate once your required minimum distribution starts at age 72.
Or pay, if not at a lower rate, at least while in your earning years, for example, where you have the opportunity to replace that money that you're going to give to the IRS, in
Sure.
taxes when you do make that conversion. So your opportunity to replenish the bucket, if you will, is greater in your earning years. So, it all has to be looked out. And as we're saying, we're creating here as a strategy and a structure to support that strategy, right? It's not just accumulate as much as you can. And we hear all about, and we've been taught to think, well, it's about a 4% withdrawal rate. Those are just rules of thumb. Those are just old tales that people.
The NFC or the AFC, whoever
we need
wins.
to stay away from that as much as possible.
So we don't deploy NFC AFC strategy. Is that what you're saying?
The Super Bowl strategy.
The Super Bowl strategy.
Yeah,
who wins the
exactly.
Super Bowl depends on which way the market's going to
go. So once you have the strategy and you create the structure to support the strategy, then it's funding it, and then it's planning for those cash flows, right, in retirement. Taking as, tax-free, taxable to support the future liabilities of healthcare, taxes, and, needs in your retirement. Not just your basic needs, but all the fun needs as well, right? We talk about this quite a bit. What do you want to do in retirement? Tell us about the goals and dreams that you have, the family vacations, the trips, et cetera.
Well, something that every client says is, I want peace of mind. Remember, they always click that in the
Less stress.
Peace of mind. We have sort of this onboarding process that we do, and figure out what their anxiety points are, and that's always one of them. And sometimes you think, how could you even be stressed now? But but that's something we're always striving for, is less stress, peace of mind, and it's that's something that annuity salespeople will always try to flip on you. They'll try to give you this fear. Oh, if you have this, it's secure, and you have this, you have no problems. And
it's a very heavy fear strategy of sales.
Yes,
to create in the mind of the client the fear of running out of money in retirement and being indigent. I mean, it's just an incredible amount of fear. And then, lo and behold, exactly what they have in their back pocket will solve that.
Yes, exactly.
We haven't talked about too, but we plan for increased inflation costs, both with healthcare as well as
I think
inflation.
that's a great point.
Throughout retirement. A lot of these fixed annuities that they guarantee these payouts aren't even adjusted for inflation. So if you think of a 30-year period like we planned in 95, let's say you retire at 65, you're losing a ton of purchasing power over those 30 years if your benefit is not increasing with inflation. So there's a lot of things that you really need to think besides what that monthly payment looks like.
Less stress, peace of mind. This is how we solve it. And it's creating a buffer between you and market volatility. So it's really simple. If your portfolio is having to generate $60,000 a year for your income, in addition to your Social Security, in addition to maybe a pension, then we just multiply that times 2. So we're going to keep $120,000 inside a cash account. And the whole purpose is if the market's misbehaving, the world's coming, falling apart, sky's falling, then Brad, you don't liquidate any part of the portfolio to cover those withdrawals you pull from that cash account.
That's right.
So that cash account has 2+ years worth of payments
Of monthly
to the
withdrawals.
client of monthly withdrawals. And if the market's high, that's when we take our gains and we move it into the cash account for the next 2 years.
Mm-hmm.
So the cash account could go down to 3 months remaining before we replenished it, or it might get replenished, only after 3 months of spending.
Right.
But the idea is that if you go through any period of time, go to Yahoo Finance and type in S&P 500 and you'll see a chart and you see, just wild and crazy up and downs, right? At times. But if you go any 2-year period and you didn't have to do a withdrawal, you're most likely never going to have to sell for a loss. And that's the whole idea. And that allows us on the portfolio management side to be able to take advantage of the situation. So now we could move slightly more toward equities in a down market, or we could sell our bonds for a gain and buy more stock to rebalance the portfolio as we did in 2020. So it's keeping a level head about you. And then the other part, the best defense is not only having the 2-year cash bucket, but you're also going to have at least $50,000, if not more, in cash reserves yourself inside your own money market account, right?
That's right.
In addition to that, we hope that we've done enough planning with you before retirement that you're debt free. So if you don't have any debt payments, you've got probably a year's worth of reserves on your own, plus 2 years inside a portfolio. And then the rest of the portfolio is being invested, traditionally. Then we can eliminate all that fear that they're trying to sell you that annuity for. Because when they sell you that annuity, the advisor's taking home 10% commission. That's when they lock your money up for 14 years, right?
And your account value is going down each year. Eventually, the goal is to deplete it, or when you pass away, there's no longer assets. I think what we see a lot of clients be really surprised of in a good way is when you show the cash flow chart in retirement, let's say they have that 4% withdrawal rate. Hopefully, their portfolio is getting 5.5% return. So technically, they're not even withdrawing from the principal of the account. And so while they're still withdrawing to live on to make up for that income gap, their account's still growing for future retirement needs, which is a good feeling.
Right, to offset inflation, as we mentioned earlier. So it's very important that the investment manager has the option to take market action during this time period of withdrawals, or to defer market action and utilize the cash bucket to make those monthly payments to the account holder.
Right.
So it really gives the investment manager a lot of options in terms of where to draw the money from in order to have both a near-term aspect and a far-term, as far as 30 years, as we talked about, aspect at the same time.
Yeah. So we're able to walk people through this process, but even if you're a do-it-yourself or investor, just create enough room between you and the portfolio so that you don't have to take unnecessary action because you needed money. That was a hard lesson for me during the financial crisis, was having to not having enough cushion, even for working people, because people were losing jobs left and right. But even for working people, realizing that, okay, we all need to make sure that everyone has reserves built up in that kind of situation. And I was a young advisor back then, and that's where wisdom comes from, right? Over for me, 22 years. Brad, for you longer. Matthews, how long you been at this? 15.
Going through the recession. I've seen the recession firsthand, so that was a big one.
Yeah, so that's where get some street cred during that whole process. But you have to have cash reserves to make the whole thing work. But then ultimately for taxes, as Matthew said, you probably pull in from brokerage account, IRAs, and then Roth accounts in that order to optimize your retirement. But again, we have to develop a strategy for each individual person because each one is a little more unique than the other.
Absolutely.
And we haven't talked about this, and it's kind of getting ahead, but obviously with the rules to the changes of IRAs, some clients might want for legacy planning to keep that Roth. So rather than if they needed the Roth up front, they might want to delay that so that it's passed on tax-free to their beneficiaries as well.
Yeah, that's a good point. Kind of transition out of, cash flow in retirement. I guess it's still related, is the inflation component to it. Matthew alluded to it earlier. It's easy to calculate retiring today. It's hard to stay retired 20 years from now, especially if you're retiring younger. So you have to build in inflation. That's tough right now because inflation, over 8% now over the last 12 months.
Yes, it is.
So we're not building in 8% inflation into our plans, partially because we don't believe that it's going to stay at 8%. It's going to come back down closer to 3%. Fed says 2%
at some point.
At some point, right?
Well, historically, it's been that even with the 70s and early 80s. So it's kind of the ballpark you want to try to plan for. If we plan for 8% inflation, these numbers are going to be pretty significantly different.
Yeah, you need almost probably 4 times what you have now. So you don't want to account for that. But you do want to account for a 2.25% pay increase every year to keep up with basic inflation. And I always say retiree inflation is not the same as working people inflation.
That's a great point. And that's what I was just thinking of, is that we all experience inflation a little bit differently based upon our circumstance. For those of us who own homes right now, we're not experiencing the cost of housing inflation. Okay?
Right.
Our housing costs are fairly fixed. For those who will be buying homes in the near future, this is a real inflationary cost in their life. For people who are out looking for a new car, they're experiencing car and cost inflation.
Right.
We all tend to experience it through energy costs and food costs, right? But those tend to be stripped out of the inflation numbers that we see because they're variable by region as well. So we all experience inflation a little bit differently. And so you can't peg the 8.5% because we're not all experiencing 8.5%, but we're all experiencing some level of inflation. And in retirement, as you mentioned, we want to have all the debts paid off so we're not incurring extra interest costs. We want to have as many variable costs set aside in a pool of dollars in an emergency fund so they can easily be taken care of. And that way it keeps not just our costs low, but it keeps our exposure to inflation as low as possible as well.
The best way to simulate that in DIY planning is probably just to reduce your rate of return. So if you have if you're calculating a 7% rate of return per year, reduce that by 2.5%, and that would help you make sure that because you should outperform that, right? And so
Yes.
that outperformance would be inflation.
I think Matthews wrote a blog on the rule of 72, didn't you, at one point in time?
Yeah, I have. Kind of like you said, the rule 72 is divide 72 by the return, and that's how long it would take your assets to double.
So you use that with inflation.
Yeah.
Okay.
True.
So let's just take an easy, 3% inflation or 4% inflation divided into 72. So if it's 2%, it's easy as 36 years from now, everything's going to be doubled. Okay.
Yeah.
If it was 4, it'd be 18 years from now, everything would be doubled. That loaf of bread, that gallon of gas,
Right.
the electric bill, et cetera, is all doubled. And this all has to be considered in a expanded lifetime that we have now. We're planning out to age 95 for a retiree at 65. So it's going to double in their lifetime easily.
So talking about that, let's we got a few minutes here before we wrap this up. Let's shift gears just a little bit, Brad, and let's talk about bonds right now. So we have a high inflation environment. We have bonds that are not performing how people view bonds. I can't remember a time in my lifetime where I've seen negative 4% bond portfolio.
And that's still the point. I don't mean to interrupt, but that's the whole point right now is that we've been in a 50-year bond bull market.
Yeah.
Okay. Nobody has essentially seen this. Money managers, professional money, have
They
not
talked
seen
about
this.
it for years.
Oh,
and
absolutely.
We've
They
been
kept
prepared
playing-
for it for years.
But it never happened. It never happened.
Right.
Now it's happening. Okay. But you have cross currents that are occurring at the same time. You have rising interest rates. You have inflation. You have the Fed's balance sheet that they're trying to reduce. They've stopped buying bonds, so that produces less liquidity in the system. They're going to withdraw bonds from the system now off the Treasury's balance sheet, and that's going to reduce liquidity in the system. So you have all these cross currents that are going on at the same time. The only thing that we can kind of look at and plan for is the expectation that the Fed is going to raise rates. They've raised them once at this point in time already, and they expect to raise them throughout the year 2022 and into some 2023. So that's the one thing that we can count on. Now, the question and what we can look to is the bond market itself and the bond investor. How have they reacted? Remember, the markets are a futures discount place. So it's trying to read the future and discount that back to today and price it in today's dollars. Well, as you've mentioned, Casey, we've seen negative 4% returns on bonds. This is unprecedented in our investment lifetime, if you will.
So why don't we liquidate and sit in the sidelines until it gets better?
Well, that's a great question. I mean, and all investment managers need to consider that relative to the long-term effects on a portfolio. Well, right now, we believe that the market is fully priced in. So these interest rate raises that the Fed's going to do is pretty well baked into today's prices. Okay, we may see a little bit further reduction, but not another 4% that we've already seen. When we're looking at portfolio management and looking at the expected returns across different asset classes and trying to predict a higher probability of a rate of return in order to achieve a retirement objective, these market movements are already baked into our assumptions. They're already in our assumptions when we're looking at these long-term rates of returns. So now any new money that's going into the bond market is buying it at a discounted rate. You're buying it at the current interest rate, even though the coupon that's being paid on those bonds remains the same. The valuation of the bond has adjusted to make that rate equal to new money and new investments in bonds themselves. So the reason to continue to invest in bonds now is that new money is getting a higher interest rate paid on that money going forward. And so they are going to continue to behave as we expect them to going forward now.
But so I guess essentially when you're buying a bond fund, the fund has to liquidate, because if you own a long-term bond fund, after a couple of years, those bonds are no longer considered long-term. They're getting closer to the maturity date, so they move to intermediate, then they move to short-term.
Mm-hmm.
So as those bonds are being sold, those bonds are get sold for a loss now. But then that new money comes back in and is buying bonds at a higher yield.
Correct.
Right? So that's going to take some time to sort through that. I think in the ag, it takes about 7 years for it to completely cycle through.
That could be, because the duration is around 6 to 7 in the U.S. ag. So that could very well be the case. That's why we have deconstructed the ag in our portfolio and utilized those different time frames of short-term, intermediate term, and long-term to take advantage of how quickly bond managers and these index funds can recycle, as you're essentially saying, those
Right.
bonds that are in there as they mature or mature out.
So if inflation is 8%, my bonds are down 4%, so my cost of living is going up. Again, why do I have a bond in my portfolio? I mean, is it there only for risk management? Is that the purpose? I mean, because we are getting a yield, but the yield's smaller.
Right.
We're yielding what, 1.5%, 2% now on shorter term bonds. So the yield's not real big. You know, I mean, I'm paying devil's advocate. I know the answers.
Well, risk management is a huge part of investment management, portfolio management, managing the risk. Risk is not a flaw of equities. Okay, risk is the benefit of equities, but it has to be managed. It has to be properly adjusted in a portfolio. When I say it's not a flaw, it's the fact that equity prices will go up and down from time to time. The benefit is that they go up, and that's why it's called the risk premium. If equity prices always went up, there wouldn't be a risk premium. Everybody who invested in them, and the risk would be low, and so would the return.
Yeah,
it's not a flaw that equity prices go down. It's a benefit because that's what creates the risk, which gives us the risk premium, which gives us the higher return in equities over the long period of time. But again, that has to be managed in the short term by utilizing bonds that have a lower risk premium and a lower rate of volatility.
So we manage the bond market by being shorter term, but also you want to have bonds in a portfolio for the black swan event, for the things that we don't know that are around the corner. And I feel like our industry has always tried to predict the future, and they don't always do it so well. So there's a COVID crash coming. I don't know if that it's COVID this time, but it's an XYZ crash. And it's going to be temporary. It's going to be harmful. People are going to get scared, right? But the bottom line is that when people get scared, where do they run to? They run to U.S. Treasuries. Mm-hmm. And so that's what we hold in our portfolio. So it's insurance. We're holding insurance. And, do you keep paying your house premiums? Your house insurance premiums? Yeah. Has your house ever burnt down? No. But what if it did? Well, I have insurance for that. And that's kind of where I think that's the only reason to own bonds at this point. If you're a younger person, you're saving, you're probably okay in a 90%, 100% stock portfolio. But as we age, we want to take off that risk, that edge of the market, right? And the only way to do that is with short-term bonds. I don't know of any other way to replicate that inside a portfolio. I mean, not
without adding more risk to do it.
Correct.
Yeah.
Yeah. There's no secret sauce.
Right. So when people say, and investors say that, look, to invest in, a fixed rate, a bond that's paying, a small amount of return. Okay. And people are saying, well, why are we doing that? I could be getting a higher rate of return in equities. It's that opportunity cost. That's the risk premium. Okay. Right. That's the risk payment to have a portfolio that can increase in value over time. You pay a little bit of insurance cost by investing in bonds. So it's a known cost going in. It's calculated into it, but it needs to be paid in order to absorb the times when the valuations are depressed. So that risk premium is very real, and it needs to be recognized. And for long-term investing, these blips in the marketplace, this blip that we're experiencing now, in a year or two on a chart that you were mentioning earlier, you won't even be able to find it. Okay? Because I don't think we're going into a recession, and that's a whole nother conversation.
Are you talking about the equity side or the fixed income side?
The fixed income side, is you won't even be able to see this on a chart in time.
Yeah. Well, again, if we went into a deep recession, I would think that interest rates have to come back down, bond prices get pushed back up. So that part of the portfolio would be structured very well for a situation like that. But ideally, it's kind of like, you're getting bombarded on the fixed income side. You just want to be very short term, very
high quality,
protect the bond portfolio, and then when interest rates appear to be topping out, you come out. It's like the sun's coming up.
That's right.
You come out, and then you
lengthen your maturity and your duration of the portfolio to take advantage of the higher paying coupon rates.
That's correct. So in the storm, you take shelter. When the sun's out, you get out and you stretch your legs, and that's the duration. That's the maturity date.
It's a great
goes
way
out
of
to 7, 8, 9 years, and then during the next recession, you're going to really profit from that on the bond portfolio. It's literally, I feel like it's been like 3 decades that we've been sitting here waiting for all this to take place, and it's just now really hitting. So, for retirees and cash flow, you got to stick to fixed income. You got to stick to the model, stick to the portfolio, and then sometimes you just have to write it out. Sometimes the best answer is not always doesn't always make sense, but we know throughout history what our highest probability of success is, and that's what we focus on.
Which is easier to do when you have a plan and have thought that through long term.
That's right.
Yeah, absolutely. All right, guys, great conversation. Thank you.
Thank you.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore. Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.